Good afternoon, everybody. I think we should maybe start. Thank you for coming. We thought of adopting the old regime this year again, back to the in-person type of presentation, that you have a more cozy environment and you can say things that you can't say otherwise because you don't know who's online and listening to you. So that's maybe and we'll, that's really the reason why we adopted the in-person approach again. And thanks for coming. We know it's a busy time of the year. Once again, the three presenters, Annabel Bishop, the Chief Economist of Investec, which will start, and then Gerard and myself will try to follow in her footsteps. Not much this year, but we're still waiting for our new Taxation Laws Amendment Act of 2025. Nobody knows when it will be promulgated, and that's the interesting thing, and that's the consequences of the last year fiasco. But thank you so much, and over to Annabel. She said that she'll take questions as well, so to the extent that you have any questions from that perspective, please don't hesitate to ask her, and she'll try to respond to that and as best she can. So from that perspective, first to Annabel, and then Gerard and myself. Thank you so much.
Shared to you. Today we're going to look both the South African economy, as you know, and of course also as well what happened essentially in the budget. The key point really is that South Africa's economy has been quite weak. Just waiting for the slides to come up, please. So South African economy has been quite weak, and of course, we find ourselves in a situation over the last few years where growth has been quite modest, really tailing off, I think, in general. If you have a look in 2011, we had growth to 3%, and then over the past decade, it really dropped down to about 0.2. Of course, we had the COVID impact, and then really moving, through the last couple of years. There we go, you can see it now. Really moving through the last couple of years, you can see that, we've seen economic growth lift a bit from this year. Compared to last year, we expected 1.3%, and then moving forwards, obviously what that really has as an impact on the outer years GDP growth as well. So I'll explain what happened there. This ties into the budget quite closely, and now that we have got the slides on the screen, we're looking at, as I said, GDP growth for 1.3% this year, over 0.5% last year. The difference in the growth really was that we actually saw agricultural production really give a strong boost to economic growth. This lifted the economy to 1.2%. Without that, last year would have seen GDP growth of 0.7%. So those windfalls came through into the government tax revenues, and of course as well, we also saw the improvement coming through quite significantly into the government coffers from the windfall from precious metals. So, over the course of 2025, there was concerns about trade policy and how that would obviously impact South Africa's economy. The exports to the US are quite modest. They're only about US imports from us about 1%, just under that, maybe 0.9%. And then for us, our exports going to the US are only about 7% of total exports. So you can see there's not a very large impact that was expected. And in fact, we've actually seen an improvement. Globally, the South-South trade, think of the Southern Hemisphere, saw a lift of about 10%. South Africa is running a larger trade surplus than it was the year before, and overall South Africa is finding itself in quite a sweet spot with low inflation, lower fuel prices, the improvement in the rand, substantial strength in the domestic currency, lift in economic growth, obviously coming through from the agricultural sector, and of course we also found ourselves experiencing benefits from the risk on in the global financial environment. The slide I wanted to take you to in today's highlights obviously is the budget. The headlines really are that there's debt stabilization now. So, that is absolutely key, because South Africa was seeing a debt trajectory that was running away with itself. We were really experiencing continual fiscal slippage, which means that while we say our debt is going to peak at perhaps, 75%. Then come the next year, it's a little bit higher than that. Come the next year, it's a bit higher again. We never quite get back to fiscal consolidation. And interestingly, fiscal consolidation is close to 60% for GDP, debt to GDP ratio, and close to 3% for the fiscal deficit to GDP ratio. So GDP itself also quite key. We've actually seen the downward revision to inflation from National Treasury, finding a situation where we've actually had a slightly lower nominal GDP that gives that denominator a bit of an impact. And of course, that's pushed up our fiscal ratios a bit. So all in all, it was a good budget, but there are some little details behind it. And, one of the key areas, of course, has been this big revenue uplift. And really, for the course of the current fiscal year, which ends in March, as you know, and then the one that we're going to get the tax relief in, that starts in April, overall, the revenue overrun's been close to 55 billion. And that's enough to not have a situation where we find tax increases in either of those years. So that's a key point. We've are seeing no tax proposals over the medium term. And of course, that really means that there's a stronger impetus to the economy as well. That tax relief comes in the form of bracket creep. As you know, the fiscal drag happens when people get salary and wage increases that push them into a higher tax bracket. And of course, if they then have tax increases on top of that, it then eats away and can actually even result in less in terms of their income, their take-home income. So these are key points for South Africa. There's been a bit of an adjustment around the fuel levy, but suffice it to say that revenue growth is now expected to run at between 5 to 6% over the medium term. And this is all main budget figures. The revenue overrun in 26-27 with this year's figure as well is expected, but it is a close thing because we cannot expect to see that we're going to have a boom in precious metals prices every year. In fact, if you actually have a look at what happened in agriculture, we now found ourselves in a situation where last year saw very favorable weather conditions, which resulted in big agricultural production jumps. But the year before that saw a drought, and 2023 as well. So we had a statistical base effect. We were coming off a low base, plus we had very good weather conditions. This year is not going to see it replicated. We're not going to see that statistical base effect again. We're having similar, good weather conditions. So overall, that boost from that area cannot be expected to occur again. We're looking for economic growth similar to last year now. And I think if I just go back to that slide so you can see, we had growth around 1.5% for this year. Last year might come out at around 1.3%, but over the medium term, we're expecting growth to rise to 3.3%. This will bring down the unemployment rate. We expect inflation to remain around the 3% mark, and of course as well the prime overdraft rate to see a moderation further in interest rates. The key point really, if I go back to the budget here, is that we find ourselves with lower debt service costs because the lower inflation has seen about a 200 basis point drop in the bond yields, which in turn lowers borrowing costs by about 6 billion. And of course, the general fuel levy, as you said, on balance stays unchanged. But of course, we do see a primary balance surplus over the medium term. And that just means we are spending what we are collecting, or we're actually spending less than we are collecting if you exclude the interest expenditure. So overall, credit ratings are expected from S&P in the next 18 months and by Fitch and Moody's equivalent, possibly over 3 years, if debt to GDP nears 75%, the economic growth accelerates to 3% by the end of this decade. They are talking about a fiscal anchor. It's really saying that, the fiscal anchor would really perhaps, and is expected to look at debt. It might say that we don't want our debt to GDP ratio to go over 75%, and therefore we can't have additional expenditure in the face of this if it pushes it out. It is expected to be flexible, the fiscal anchor, and that target, really the fiscal target, will mean that we find ourselves in a situation where perhaps economic conditions deteriorate, we might be able to exceed it, like we can the inflation target. But overall, for the budget, as I said, it was a good budget. Most of the outcome was really factored in. The JSE did gain, but the Rand was seeing quite a flat outcome. We must, of course, recall that we had the usual increases in sin taxes, whether they're excise duties and alcohol beverages and tobacco products, and, of course, as well, good news for small businesses. And that comes through in terms of a shift in the VAT. I'm not sure what happened there. I didn't do anything, but I hope you can still see. There was a shift in the VAT registration threshold. It increases to 2.3 million. So that's a real positive as well for South Africa. And obviously, that's also helpful to see economic growth strength. And in fact, government lifted its growth forecast to 1.4% from 1.2% for last year. And of course, we have 1.3. It could come out at 1.3, 1.4. Next year, we're seeing 1.6 from 1.5, and the following year remains at 2028 remains unchanged at 1.8%. I do want to leave some time for questions. The tax relief obviously occurs on the medical income tax brackets and rebates, and medical tax credits are also adjusted in line with inflation. Okay, I think I might just pause for a question, although I did actually forget to add tax-free investments limit is now increased from 36,000 to 46,000. Yes, so let me pause for any questions. I don't know if anyone wants to feed a question through. If you want to raise your hand. If you're online, if you want to, perhaps someone wants to feed me the questions from the room.
We've got a mic here if you would like to ask a question. Annabelle, I think we're good.
Good. Okay, perfect. Then just to end off with our inflation forecast, I'm sure everyone's always quite interested in where we're going to go. You can see that both for PPI and CPI inflation, as I said earlier, we're running around the 3% mark, which is really key for the just maybe rather go to the next slide like this, whereas really key for interest rates. Interest rates, we actually think we could see further significant cuts. We're at 6.75 at the moment. And of course, in the start of 2026, we didn't see an interest rate cut. We expect more cuts over the medium term. And that's over a 1% cut in interest rates out by 2030. And then from a salary and wage perspective, we have seen some fall in real and nominal terms. But of course, with the bracket creep relief, that should result in an improvement in the outlook for the household sector as well. From a bond perspective, we've seen that sharp drop down from government bonds, around 200 basis points improvement in bond yields. And looking forwards, we think that we will continue to see this lift. The credit risk, I just wanted to show you this before I end off. This gives you a really good idea of credit ratings. Currently, South Africa is sitting here from a credit perspective from Moody's and S&P. And in order to get back to investment grade, we would just need to see a 2 lift, so go up by 2 basically rankings from BB plus into BBB minus. We think this is doable. We think over the next 5 years, we probably will return to an investment grade credit rating. So overall, we have seen a very positive economic environment, but there's a lot more to come. And I think that we have reasons to be optimistic. We haven't touched on other positives, which we've seen, such as getting off the grey listing, and a number of other areas, such as the improvements from Operation Vulindlela, the cessation of load shedding, and the main improvements at the ports, and a number of other areas. But I think, just to keep this presentation short within time limits, I'm going to stop there. And if anyone does want to email me and, ask further questions, you're obviously very welcome.
Good afternoon, everyone. Thank you so much, Annabelle, for that analysis. We really value your input, and thank you for breaking down the impact of the budget for us, or the economic impact of the budget for us. We appreciate it very much. Thank you. Yeah, from a value-added tax perspective, I think there's not a lot, but there are certain aspects that I think that are important. Well, firstly, if we just look at the revenue, we're looking at revenue being collected in the amount of 497 million towards the end of this fiscal year, which is about a 40 billion rand increase over last year, which is about 8%. And the VAT collections are projected to be about 24.8%, just under 25%, or a quarter of total tax collections. Now, over the years, even when the VAT rate was increased in in April of 2018, from 14 to 15%, the total tax or VAT collections remained around about 25% of total tax collections. And we're still there at this point in time. As far as the VAT rate is concerned, no surprises there that the VAT rate in a election year remained the same. We didn't have the same issues as last year, fortunately. Although the VAT rate remained unchanged, and that is good news for the consumers, I think from a business perspective, one actually need to take cognizance of the fact that SARS need to collect additional revenue. If they don't going to get it from an increase in the VAT rate, there are other means that they will apply. And I do think that one can expect enhanced enforcement with regard to the legislation, particularly more aggressive collection measures that we may see from SARS, and certainly more focused audits that are enabled through algorithms and artificial intelligent risk profiling tools that SARS is currently implementing, and also more experienced staff that they are employing in order to carry out their audits. I think we can also expect more disputes in their quest to collect more revenue. They can be expected that there will be certain disputes that SARS want to take through the courts in order to establish precedents, in order to enhance their tax collections, particularly from a VAT perspective. Now, before I go into the proposals that were made in the budget earlier today, I just wanted to deal briefly with the VAT modernization project that SARS has implemented. As far as the VAT administration process and the return and administration process is concerned, we know that it stayed virtually the same since VAT was implemented just under 35 years ago. And that is that you collect all the information from your systems, you use that reports to complete the VAT return, then you submit it to SARS, and they then carry out their verification reviews. When VAT was implemented, those returns were submitted or completed manually, they were submitted manually. And then since the introduction of e-filing, which is now submit the returns electronically, make payments electronically, but it's still a process where you collect that information from the system, you complete the returns, and then you submit it to SARS for their verification. In 2023, the minister, in his budget review at that point, indicated that SARS is embarking on a VAT modernization project. And later that year, it was in August of that year, a white paper was published. There was an updated paper published in October last year, which expanded this modernization project of SARS not only to VAT, but also to include customs processes and other processes of SARS as well. Now, from a VAT perspective, this VAT modernization will completely change the way in which VAT administration and the reporting framework will be carried out. And that entails the introduction of electronic invoicing and real-time data transmission to SARS. In other words, as and when you process your revenue transactions, whether it's through a point-of-sale system or whether you issue sales invoices, and on the other hand, as and when you process your supplier invoices, that data will be interfaced directly with the SARS systems, real-time or near real-time. So SARS will collect all this information directly from your systems. The VAT returns will be pre-populated, very similar to the personal income tax returns that are currently being pre-populated. The same will apply to the VAT returns. So SARS will complete your VAT return for you, and then you would need to carry out reviews to determine whether it's accurate and complete. As far as the process is concerned, SARS has indicated that they will carry out this modernization project in various phases over the next 2 to 5 years. So we've already seen legislation amendments in the last legislation amendments as far as the VAT legislation is concerned, where SARS has introduced terms like e-invoicing, e-debit notes, e-credit notes, and e-reporting. And the provisions of Section 74 that deal specifically with regulations and enabling the minister to make regulations has been expanded as well to enable the minister to make regulations to facilitate this electronic interface and reporting process from a VAT perspective. There is, quite a significant impact on businesses, I would think, because already at this point in time, one would need to carry out detailed reviews of your systems to ensure that VAT is correctly and accurately accounted for, that the VAT coding on transactions is correct. Whether a transaction is standard rated, zero rated, or exempt, that is quite important. If there are complex transactions, it's best to determine what is the VAT, the status of those transactions. And if there is any uncertainty regarding that, it's best to go to SARS, obtain a ruling, or obtain a legal opinion to clarify what is the status of those transactions. And then further, with regard to manual processing, that's not going to happen anymore. So if you have a manual intervention in order to complete your return, that is something that one seriously need to look at to eliminate that. Where you have large refunds in a particular period, the tendency was sometimes not to claim it all in one period, but to spread it over a period to avoid a VAT audit. Now, that's not going to happen anymore either. So where you've got a substantial input tax deduction, that will have to be processed in that period. So, also from a systems perspective, one would need to realize that you would have to change your systems or adapt your systems in order to facilitate this electronic invoicing, whether it's invoices issued or invoices received from suppliers. In order to do that, you're going to need more, or additional software that's compatible, or you would have to introduce a new system. And that's going to cost you money as well. So the cost of implementing this is on business. So in your budgeting process, one would also need to take account of that and to ensure that somewhere down the line, when we have clear instructions or guidance from SARS as to what your systems need to be complying with, that at that point in time one can actually implement all these systems. Okay, if we look at the budget proposals specifically, what has not changed is the list of zero-rated food items, and that is to be expected, because if you zero-rate or expand the list of zero-rated items, it costs the fiscus money. And that will normally not happen unless you've got a VAT rate increase. So if you have a VAT rate increase, you need to provide relief to poor or low-income households, and that will normally come in the form of additional zero rating. So it's not surprising that even though there were quite serious lobbying processes, particularly to zero-rate chicken, that didn't happen in this year. The compulsory VAT threshold, as Annabelle has mentioned, has fortunately, after 17 years now, increased from 1 million rand to 2.3 million rand, and that is to be implemented on the 1st of April this year. Just a word of caution here that if there is now a cancellation of the registration because you don't or no longer exceed the threshold, or if you're under the 2.3 million rand threshold, there is a deemed supply in respect of all the assets and rights capable of assignment on hand at that point in time. In the past, when the rate was, when the threshold was increased from 300,000 to R1 million, there was relief provided in the legislation that you then can pay the VAT that results as a result of this deemed supply of assets on hand over a period. And I expect that the same will happen in this case as well. There is a proposal to clarify Section 11.2k. Now, 11.2k, amongst others, provides for the zero rating of supplies made to a customs-controlled area enterprise or to a special economic zone operator. The question was, or the uncertainty was, as to when does this zero rating apply? And the proposal is that the zero rating will only apply if services are rendered physically in the customs control area. So if it's rendered from outside to a customs control area enterprise, that will not qualify for the zero rating. The service must be rendered physically within the area. The supply of gold to banks, the South African Reserve Bank and the SA Mint Company is currently zero rated in terms of Section 11.1f. There's an interpretational issue with regard to Section 11.1f as to when does the zero rating apply. And there's currently a case being decided by the Constitutional Court. The hearing has already taken place. We're waiting the judgment of the Constitutional Court as to what is the correct interpretation of 11.1f. And the issue is here is whether the zero rating still applies if the gold that is supplied to the bank was subject to a process of manufacture before the gold product that is supplied to the bank is provided. So SARS has decided that because of this complication and in the interpretational issue, that they're just going to repeal 11.1f in its entirety. So any supplies of gold to these entities will then no longer be zero rated, will be subject to the standard rate if this proposal is adopted. Electronic invoices, invoicing, in terms of the legislation, Section 54.2 capital B, if you supply electronic services via an intermediary, then there's a deeming provision that those supplies are deemed to be made by the intermediary and not by the supplier, meaning that the intermediary is then required to account for output tax on those transactions. But there is a requirement that there must be an agreement in writing between the supplier and the intermediary for that deeming provision to apply. But it seems that there are issues with regard to entering into a written agreement between the intermediary and particularly smaller suppliers. And then SARS has difficulty in collecting the VAT from the principal, the supplier, as opposed to the intermediary. And what they're proposing doing now is just to flip it around to say that the intermediary is deemed to supply the services, meaning that the intermediary needs to account for the output tax unless there's an agreement to the contrary. There's a proposed amendment to leasehold improvements in the sense that leasehold improvements, currently Section 18 capital C, provides that if a lessee carries out leasehold improvements, then that leasehold improvements is deemed to be a supply to the landlord, to the lessor. If the leasehold improvements is used for the purposes of making taxable supplies, for example, for commercial purposes, then the value of that supply to the lessor is deemed to be null. But if those improvements are used for the purposes of exempt supplies, for example, residential property, which is let as residential property, then the supply to the lessor is deemed to be for the value of those leasehold improvements. But that is only if the lessor is a vendor for VAT purposes. If the lessor is not registered for VAT purposes, then there's no, Section 18C doesn't apply. And Section 18C was implemented, and the reason for the introduction of this deemed supply is to put the lessor in the same position if the lessor had effected those improvements itself. So there would have been a VAT cost which was not deductible by the lessor. But if the lessor is now not a vendor, then there's no supply, but the lessor will still get the benefit. So the proposal here is that to introduce a provision into the legislation similar to 18C that also applies to non-vendors, and to put and to introduce a payment mechanism for the non-vendor lessor then to account for the VAT. Currently, if you submit your returns via e-filing, then you only need to submit your return and make payment by the end of the month. Whereas if you submit it not by e-filing, and I didn't know that there were still vendors submitting not via e-filing, but then you need to account for or submit your return by the 25th day of a month. The proposal here is just to remove the distinguishment or the distinction between e-filers and non-e-filing, so everyone will submit the returns by the end of the month. Then just lastly, it seems that there are certain issues with regard to second-hand goods, and particularly with regard to the exportation of second-hand goods. Now, where you acquire second-hand goods, then from a non-vendor, or excuse me, under a supply which is not a taxable supply, then you're entitled to claim a notional input tax deduction of the goods that you acquire. But if you export those goods, then the goods cannot be zero-rated for VAT purposes because there's a clawback of that notional input tax deduction that you have claimed. It seems that the issue that has arisen is that you are entitled to claim an input tax deduction within 5 years from the transaction. So it may happen that you acquire second-hand goods, you don't claim the notional input tax deduction at that point. You export the goods, and because you didn't claim a notional input tax deduction, the total exportation is zero-rated. But then you go subsequently, and then you claim the notional input tax deduction, whereas the export at that point was totally zero-rated, and you didn't have the clawback. So what they're proposing now is that you cannot claim a notional input tax deduction in a tax period subsequent to your exportation. So if you haven't claimed it up front, then you can claim it if it is within 5 years, but not later than the period in which you've actually exported the goods. With regard to the documentation, it seems that SARS still has an issue with regard to the documentation in order to support the notional input tax deduction for second-hand goods. So with regard to traders, the proposal is now that in addition to the list of documents that you currently need under Section 10, subsection 8 of the legislation, you also would need to comply with the documentary requirements of Section 21 of the Second-Hand Goods Act. Now, I've looked at that, and it's very similar to what we have currently under Section 20, subsection 8, but there are certain additional requirements that you need to keep a register of the goods purchased and sold as well. And then again, coming back to the zero rating of goods where you have claimed a notional input tax deduction, the clawback is with regard to the notional input tax that you have claimed when you export those goods. So if you sell the goods for a price higher than to what you purchased it, then you can apply the zero rate, but only in respect of the excess between the purchase price and the selling price. In order to facilitate this and probably to introduce an audit trail, is that the requirement is now that if you export those goods, the tax invoice that you need to issue, in addition to the normal requirements, you also now need to reflect the original purchase price of the goods and the notional input tax deduction that you have previously claimed. Now, of course, in these circumstances, you would totally then disclose your margin to your customer. But in the past, where you have then applied the clawback and charged only VAT on your profit margin, it was, the customer was able to calculate for themselves anyway what your margin is. So, yeah, those are the proposed amendments from a VAT perspective. And before I hand over to Emil, are there any questions with regard to these proposals or the amendments that SARS and National Treasury is looking at from a VAT perspective? Okay, if not, Emil, then over to you.
The increase of the threshold from 2.3, I think, do you think that's going to lead to deregistration of those entities that are below that threshold? Thank you. And what's the effect of that?
Yeah, I think where entities are registered for VAT purposes and they make supplies to other registered vendors, then I don't think that there's a reason as to why they should be cancelling their registration, apart from the fact that it reduces administration. But where you do have consultants, for example, that falls under the 2.3 million, and they supply their services to mainly non-registered persons, then I would think it would make sense for them to cancel their registration. Firstly, because of the administration, and secondly, because there's not a lot of input tax deductions that they can claim. So I think it will depend on the vendors and the enterprises and the nature thereof. But I do think that because of the huge burden of the administration in relation to VAT and the submission of returns and dealing with SARS queries, that I do think that there will be a lot of cancellation of registrations. The question is, will the voluntary registration increase as well? There's no indication that the voluntary registration will increase, the threshold there will increase as well.
So just a question on the ones that were, because previously it was 1 million, right? What happens to those companies that had not, or those entities that had not registered, and now the threshold has been increased, but SARS goes back and says, but you should have actually done it in 2023 when you within 1 million.
Yeah.
Or over 1 million.
The increase in the threshold will only come into effect on the 1st of April. So up to the 31st of March, if your VATable revenue was more than R1 million, then you can still be held liable for the VAT in respect of that revenue, and you should have been registered. And we have a similar situation currently with regard to electronic services as well. Foreign entities that supplied electronic services, we saw an amendment to the regulations on 1 April last year that says that the foreign electronic services providers don't need to, or they don't fall under the regulations if they solely render their services to registered vendors. But that came in on the 1st of April, and we do have foreign electronic services providers before that needed to go back, and SARS insists that they go back and register and account for the VAT, and then they can cancel their registration thereafter. But you have to apply the legislation as it is at the time.
Gerard, the voluntary registration limit has been increased. I think it's 120.
Oh, I'm sorry, I missed that. Yeah, thank you for that. Yeah, thank you so much, Despina. So it's increased then. Thank you. All right. Thank you.
Thank you, Gerard. I'll deny it that I ever said it, but it seems that this thing called VAT may be a bit more important than income tax this year. But as I said, I'll deny it that I ever said that. Thank you so much. We all complain that it's tough to pay taxes in South Africa, and we have a big tax burden and all those type of things. So I'm not sure whether you saw the recent announcement in the Netherlands, where they actually, the parliament, it still has to go through the Senate, but they are introducing a tax on unrealized capital gains, especially bonds and shares, at the rate of 36%. So you think it's tough in Africa? Think again. Not so much. Coming back to my presentation, I said I'm not going to do this again. I promised myself, but when I saw this commercial, I just had to do it. Now, to give you some background, the Super Bowl is about more important than Thanksgiving in the United States. It's the thing, and all the companies aim to actually have the best commercial at that point in time, and they actually write the commercials and everything. So this commercial was actually rated as one of the best 10, or the 10 best commercials. Now, to give you some background, it's actually a tax consulting firm, believe it or not. And their whole intention is really to say how easy it is if you actually approach us, and then there's no problems in paying your taxes, and it's not a problem. And so it's really a commercial within a commercial. They got an actor to actually flight this commercial and assist them to make the commercial. So you'll see it's really a commercial in a commercial where they approach the actor, and the actor actually now wants to give them an indication of the taxes and all those type of things. So enjoy this one.
I can handle that for you. I can handle that for you.
Helping Adrian Brody prepare for his role as a TurboTax expert has been interesting.
I can handle that for you.
Janet.
On it.
I can handle that for you.
Try less intense. We do people's taxes for them on their phone or in person so that they can relax.
Yeah, I know, but it's taxes, so when do they cry?
No, they don't cry.
No crying.
They just go home happy.
The preparation is just really important to me, to actually become Janet.
Have you seen Adrian?
No, but he's doing an incredible job. What the?
Adrian brought a lot of expertise to the role.
Can you come in? Would you ever cry in front of a customer?
I don't see why I would.
What if the customer's dog has died? Then would you cry? Can we get him a dog?
Oh, no. He's so committed.
Your dog's gonna die. I'm sorry.
And action.
They say death and taxes are the only guarantees in life. At least death only happens to you once. Brace yourself. The pain is coming. I can taste it.
Cut! Why is there rain?
Dials it up, right?
No, Adrian, we need you to dial things down.
I'm just trying to tap into the pain of taxes.
No, you're not some regular tax guy. You are a TurboTax expert, like Janet.
We take the pain out of taxes, remember?
Let's go again. Just smile, be happy.
I don't do happy. If there's no drama, there's no Adrian Brody. I can pay for that.
I could deduct that.
Cue the rain.
So there you are. As I said, I just couldn't refuse that. Yeah, and we can deduct today's cost as well, so by the way. Let me start off with a few slides giving the lie of the land again. It's a few busy slides, but it gives you an indication of where we are from a practical perspective. If you look at statistics, this year income tax was a bit down. Last year it was up because of the two-pot system. It really boosted the revenue substantially. Then otherwise, if you look at the collections, customs duties were up. This year, more the commodity cycle, but bear in mind, it's only gold and platinum to a large extent, nothing else. So don't think that we're going to have the same type of commodity boom that we had in the early 90s and early 2000s, where Minister Manuel just had easy time, preparing his budget speech and all those type of things. So it's a bit of an interesting issue, but personal tax is ultimately the burden. That is really the core tax that funds the tax system in South Africa, and it's going to remain that way for a very long time. If you look at the statistics as well, still increased numbers of taxpayers. Interestingly enough, still a little bit more, but you can see the ladies are catching up. Men and gentlemen paying taxes compared to ladies from that perspective, but you can see this percentage is actually increases from that perspective. But interesting enough as well, look at the numbers of the people earning more than 5 million rand and in excess of 1.5 million rand. And that actually shows you how small, and when you get to the corporate income tax system as well, you'll see how small the tax base is in South Africa. This is how small it is. If you look at this, 12,000 earning more than 5 million, 163,000 earning in excess of 1.5 million rand. So it's quite small from that perspective. At least it's picking up, because when we started to look at these statistics, it was less than 5,000 earning more than 5 million and so on. And you can see it's actually increasing from that perspective, which is a good thing. But also, if you look at the right-hand slide there, that's really a comparison between the ladies and the gentlemen, which may go back to the job discrimination still, from that perspective. If you look at that, there's more ladies earning in the lower income sector compared to the gentlemen, whereas the gentlemen earn more in the higher income earning sector compared to the segment compared to the ladies. So it's quite interesting to see that breakdown of who's earning what. Brent, I hope that you noticed here, and some complaints that are going to be lodged tomorrow or maybe this evening about the comparisons. But I think it's ultimately, yes, in Gauteng, we still earn the most. It's by far the engine of South Africa from a practical perspective. So that's where we are. From a VAT perspective, apart from what Gerard indicated, who's actually contributing? Interestingly enough, you'd think that certain sectors are doing well and not. Financial intermediation, insurance, real estate, business services. That's really also from a corporate income tax perspective. Those are the sectors that are making the contributions to this, to the income. If you look at, interestingly enough, last year all the CEOs were summoned to the LBI, and they were introduced to a new system and a new division. And they were promised that they were going to be looked after because you are the most important taxpayers in South Africa and all those type of things. And it's ultimately 557 companies earning and contributing 709 billion rand worth of taxable income, resulting in 172 billion worth of tax. So once again, it's very small. Those are the companies that are contributing to the revenue pot in South Africa. Look at individuals, 10, 20,000 to a large extent, then also corporates, 557. So it's not so easy from that perspective, and we need to expand that corporate base and that tax base, because that's really the important thing in the South African context. Capital gains tax, not so much still. 17 billion, 9 billion individuals, 8 billion capital gains tax, and now you saw this afternoon, if you sell your house to 3 million rand as opposed to 2 million rand gain, that's exempt. So practically speaking, it's about all the houses in Gauteng that will be exempt, and the people in Cape Town are still going to pay a lot of taxes. So that's really, if you look at what happened to the property sector and the market prices from a practical perspective on capital gains. Collections. Now, last year, I'm not sure whether you remember, Mr. Kieswetter actually indicated, if I just get some money, I'll boost this revenue by 20 billion rand or 50 billion rand. Just give me the money because I need the money and I'm going to collect the money. Now, if you look at the message this afternoon, it's indicated, yes, SARS actually did increase its collections, but not necessarily because of those promises that Mr. Kieswetter made. It's more of as a result of the fact that certain sectors outperformed commodity, dividends tax, all those type of things because of certain high level type of transactions that were entered into, and a lot of dividends taxes were paid, especially from a restructuring process and companies actually immigrating from South Africa. So from a practical perspective, if you really look at the increased collections, yes, because, and I think Gerard mentioned that the AR and all those type of things, about 4 billion, but it's not really that much if you look at the promises that were made. So I think one should look at the collections. Yes, the collections are higher because of the increase in the economy, not so much as a result of the collection efforts. And yes, the debt decreased a bit, but not really what they expected and all those type of things. So we still have to see that coming through. And I don't think there's been that much of a success. Yes, people have been appointed at SARS and so on, so maybe we'll see that over a 2-3 year period with reference to debt collections and increased revenue collections and efforts from that perspective. Those of you that are in the high corporates, lots of talk when it was introduced, lots of effort, lots of time and money spent on the Pillar 2 legislation. Because there was this professor at the University of Cape Town that predicted at least an 8 billion rand collection effort because of the fact that South African corporates are not paying their taxes and they're all making use of tax havens and all those type of things. Now, I actually followed the financial results over the year. There was one company that actually had to pay about 300 million rand. It was quite a high-profile type of matter, where they announced that and the share price dropped because of the fact that they headquartered in Mauritius and because of the low tax rates and all those type of things. But now they're only expecting 2 billion. So it's a substantial difference compared to what they expected that they will collect. So it's also something to think about, not so much evasion from a big corporates, and I think that's the low-hanging tree, the low-hanging fruit, compared to other types of sectors. The big corporates are paying their taxes to a large extent, and they are compliant as opposed to, let's say, people not necessarily paying their taxes and other sectors that one should focus on. So that expectation has been a bit curbed from that perspective, legislation and everything, and that's then been done. So Gerard mentioned the litigation. 145,000 objections. So that just shows you taxpayers objecting. Of that, only 8,447 appeals were received. Over 1,628,000, so it reduces substantially because you can see it's mostly the individuals or smaller corporates that are actually objecting. And then 97% were resolved through ADR. I actually can't believe that, to be honest. My experience of ADR has been a bit different. Essentially, you talk, and if you're not prepared to settle, there's no settlement. So you need to pay something if you actually go to ADR. To convince SARS that you're actually correct is virtually impossible. I've got two stories to tell about that. There was one matter where the taxpayer is quite a big amount, where the taxpayer involved council, and the council made the submission for about 2-3 hours to SARS. And the council thought this was actually a very good presentation. They actually going to convince SARS. And then SARS just turned around and said, sorry, I do not agree. So that was the result in the end of the ADR from a practical perspective. I also have this long-standing joke with some of my colleagues about the success rate that I do have in ADRs. When it was started out, I think it was like in the first year or so, I was involved in about 20 ADRs, and the client asked me, how many did you win? And I said, I think 1 or so. The others I lost or we didn't agree to. But each time I actually now, where SARS actually concedes something in ADR, I actually let them know, it's 1. But I don't tell them how many other ADRs I've been involved in which are not successful. So I must, yes, if this is the case, it's good, but I must say that's not my personal experience from that perspective. But the one thing that you must appreciate, if you go to court, and if SARS takes you to court, it's quite likely that SARS is going to win, because they only choose those cases where they're going to win to a large extent. So if you at that phase rather settle potentially, unless you're very sure that you've got a very strong case from a practical perspective. The tide has turned. If you look at the success rate, it was 86%, it's now 83% and so on, and especially the Constitutional Court seems to be more inclined to make decisions in favor of taxpayers. We're still waiting with bated breath the APSA judgment on the GAR. And what the effect of that may be, we'll probably, maybe I'm thinking of doing another presentation later this year if you look at the G case and the consequences of the GAR and how that was explained compared to what may happen in the APSA case with reference to what is a tax benefit, what's the purpose, is it an objective, subjective test, all those type of things. And I think we're going to get clarity in relation to that later this year when the APSA judgment is handed down. But let's see what happens from a practical perspective. So that's really the lie of the land, but yes, it's very litigious. Don't think you're just going to settle something. If you're settling something, you're very lucky from a practical perspective, or you've got a very strong case. Even in relation to normal factual matters, I've got a couple of matters where it's really a question, was he double deducted or not? Did you make this actual mistake where the auditors confirmed something and it's still disputed by SARS? So that's the type of issues that you're dealing with when you see these assessments from a practical perspective. Okay, let's maybe go back to the merits. Given the fact that we don't have that many issues from an announcement perspective, the one interesting thing and the one thing that people tend to forget is Section 11G and interest. We had the practice note 31, and essentially there's 2 types of interest and scenarios where you deduct interest. It's essentially where I borrow money at 10% and I unlend it at 10%. Can I claim the deduction? Practice note 31 said, yes, you can claim it from a practical perspective. Practice note 31 also said, if I borrow money at 10% and separately I earn a deposit and the 2 are not even related, I can still deduct the interest. So that landscape and environment has now changed. From a practical perspective, 11G says you can only claim it to the extent that you borrow and there's a linkage between the borrowing and the unlending. You cannot now claim a deduction to the extent that you borrow money and there's separately an unlending and the 2 are not linked. They must be linked, and to that extent, even if you do not make a profit, you can still claim that deduction from a practical perspective. But it's now much more narrow compared to what we used to in terms of Practice Note 31, where you just aggregated the interest received and interest paid, and then you deducted the interest claim from the interest received, and that was your net liability, or sometimes it was actually more than that. So from that perspective, bear that in mind, because that regime has changed, and you can see from queries from SARS that they're actually now trying to track the interest deductions and the source of your interest deductions. as opposed to just aggregating everything, especially to the extent that you're an investment company and you receive interest and you pay interest. Yes, if it's the same rate, so not so much an issue in terms of 11G, but otherwise you must be very careful in relation to the borrowing and unlending, that there is a link, as otherwise it's not seen to be trading from a practical perspective. The other source, those of you that are more in the financial industry, the source of attack is really preference shares. And you can see that they didn't announce anything this year, but if you look at the trend in relation to preference shares, the way it's treated, preference shares now also part of 424I, and to the extent that there's unrealized gains or losses, you have to account for that, similar to loans. So that's quite a big thing, and it doesn't seem as if the industry has really objected that much to that, but I think it's going to have a significant consequence as a result of that. Then also preference shares, because of to a large extent how people treat preference shares. If you take security and you drop it for a minute or a day and then take the security again or take other security, you may have a third-party backed share, or to the extent that you dispose of the shares in the operating company in the context of Section 80A. In those type of circumstances, you must use the proceeds to redeem your preference shares, and you can at least, they backtrack a bit, you can also redeem and pay your outstanding dividends in relation to that. But you must you must be very careful that SARS is looking at preference shares and the way in which preference shares are structured, because they don't like it in view of the fact that it's exempt. And on the other hand, you may potentially, depending on your funding scenario, get a reduction and all those type of things. So it's one of the sources of attack on the part of SARS. Another issue that went largely unnoticed, and I'm actually surprised about that, is also unlisted REITs and the draft regulations that were published in November, December last year. Because there's always been this thrust in relation to the fact that REITs are in a very favorable position, REIT, real estate investment company, to a large extent, because they do not pay capital gains tax and they can actually also deduct their distributions, even though the distributions are taxable. So the private sector can't really compete with a REIT if you look at the net returns. And that's why the listed property sector, and you'll see that, is doing so well. Because a number of those listed property companies have actually absorbed some of the unlisted property sectors and industries and companies, and from a practical perspective, because of the benefits. Now they've indicated, yes, we relax it. It's really a first step. It's not a question that they are saying unlisted REITs are accepted, even to the extent that they're not linked to anything else. Unlisted REITs will be accepted to the extent that they're linked to insurance and pension funds, wholly owned subsidiaries of that. That's to a large extent what you're looking at. From a practical perspective, that if you are that and you comply with these type of requirements, the 300 million rand, those type of things, then from a practical perspective, you'll be able to be treated on the same basis. There's still draft regulations. Comments were made, but I think it's a sign and a step in the right direction, because from a practical perspective, you want to even out the playing field. And you need to be able to do so, but it's very limited in the sense that it's the pension funds and insurers, as opposed to your normal unlisted property companies. And I'm not sure whether they will go that far in relation to that and extend this type of exemption also in the regime to unlisted property companies that are privately owned, as opposed to owned by insurance companies and pension funds. So yes, a step in the right direction. We're still going to see how that is going to pan out. Another thing that was also once again announced this afternoon, I've been involved in a couple of hedge funds. Their returns were all in excess of 20%. Compared to other sectors that looking at 8%, 9%, 5%, and that type of thing. And the question is really, how do they achieve that? How do they achieve that? Are they rebalancing on a daily basis or a weekly basis? Do they lock in their profits on a weekly basis, all those type of things, and the type of transactions that they can enter. And then the issue really is that at this stage, pending the promulgation of the Taxation Laws Amendment Act, for hedge funds, and that's really the focus area. It seems that SARS, if you look at it also now in the National Treasury, this afternoon the acceptance is that normal CISs, portfolios of investment, can be collective investment schemes or even otherwise, that they're going to be accepted, that the returns are on capital account. And we need that certainty. I think that's really the key. We need the certainty that SARS will not attack those type of collective investment schemes or the portfolios, because you don't want a scenario where, and South Africans don't really save. So from a practical perspective, you want that type of certainty such that people can invest in CISs. But that must be available to the public sector at large, as opposed to being individuals and 1 million rand that you need to invest, and it's only for a certain number of people. So from a practical perspective, if you're a hedge fund, you're in trouble, because it may well be, and they indicated once again that they're going to remove hedge funds from the CIS regime, and that really means that you're no longer exempt. Because CISs or the portfolios are exempt in the context of capital gains made by them, and it will be accepted. So I think it's a step in that direction, but with that qualification. Also then, the Steinhoff exemption, not many people talked about that, but there were a number of transactions entered into by Steinhoff where people transferred their shareholding in companies, listed companies, because the benefit of that is really, and it's still there, the company acquiring those shares get a step up in base cost. So the transferor or the person selling the shares get rollover relief, but the company acquiring that get a step up in base cost. We call it the Steinhoff exemption. It's still there, and they actually, that's to a large extent how they made their profits, because they can immediately thereafter sell their asset without having to pay tax. So there's a number of people that made use of that. Yes, they did curb that a bit in the sense that it only applies to a person holding less than 20% of the shares, but in most instances it doesn't really matter. You know, in most instances people hold between 10-15%. So you're going to see a lot of those transactions. In fact, if you followed the SENS announcements, there were in fact a number of transactions that were entered into just before this announcement and even during the course of last year. And you see it's a huge benefit to the company acquiring those shares, because you get the step up in base cost, you don't pay tax when you sell it, and the person selling the shares to you gets rollover relief. So it's really the best of all worlds. Let's see how it happens, but it's interesting to see that that SARS has never really attacked any of these type of transactions in the past, even though it was very high profile in the context of the Steinhoff transactions. The one thing is, if it's a capital distribution by CIS, it will be treated as a capital gain as opposed to it being exempt. That's also now been promulgated, once again waiting for the Taxation Laws Amendment Bill to be promulgated. So yes, also a focus area on collective investment schemes, but at least one is unlikely to see a tax on the higher, more profile collective investment schemes like the Coronations or the Allan Greys, all those type of things, and it's merely the smaller hedge funds that may expect queries from SARS from that perspective, and the fact that if you make distributions, that it will be on capital account. Pay now, argue later. Quite an interesting case that was handed down early this year. You know the song Vat Jou Goed in Trek Ferreira. That's now what's happened, because if you look at the SARS, Section 164 of the Tax Administration Act provides for the suspension of payment of taxes once you're assessed. Now SARS and Mr. Modiba basically has a standard letter. When you submit your suspension, they say, yes, we agree that you're a compliant taxpayer. We agree that there's no fraud associated with that. We agree that that you may suffer harm, but we don't want security because that's not cash, And number two, the harm suffered by the fiscus and SARS in not receiving the payment is actually more than the harm and the hardship that you will suffer. So it's really a standard process, and then you submit your projections for the next 12 months and all those type of things, and ultimately you settle by paying something. Now, in this case, it's a bit of a muddy issue in the sense that there was fraud and security was given and so on, and ultimately the court substituted its decision, the SARS decision. But that's not so important for me. The important thing is really that the court indicated you must look at all of these factors on a holistic basis. It's not so much to say, yes, there's harm to the fiscus if you don't pay, because there's always potential harm if you don't pay, but there's also these other factors. And the fact that SARS acknowledges that you're compliant, there's no fraud, you're objecting in good faith, all those type of things, you're even potentially prepared to give security, should play a role, as opposed to one element being highlighted and being singled out, and that's really being scenario that you need to pay because otherwise the fiscus is prejudiced. So that's really the important aspect of this case to me, even though there's lots of comments about that and taxpayers now arguing we're never going to pay now if we get an assessment. Be careful, that's not so easy. If you've got cash, then you've got a problem. If you don't have the cash, then at least these other factors play a role. But if you've got substantial cash on your balance sheet and your bank accounts, and you declare dividends out. Now, for instance, I've had one scenario where a taxpayer submitted an application for suspension and say we don't really have cash and so on, but a month earlier they actually declared $1 billion dividend. So that type of thing you must be careful of. You must manage your cash resources from that perspective such that you don't necessarily have a big cash balance on your balance sheet, because if that's the case and you declare dividends, then it's becoming more problematic in order to pay the taxes, as opposed to arguing that you can give security and that type of thing. Even though in the Ferreira case they did accept the security was a substantial factor. The other thing as well is you submit your application and SARS comes back with to say this is really what the committee indicated. But you just don't know what the committee considered, because more often than not, it may be one person that made the decision as opposed to a committee making the decision. It's those type of things that now are quite important and highlighted, that SARS must follow that process, must consider these type of issues before you need to pay. Because if you look at also the statistics this afternoon, that's been one of the issues where they were quite successful in claiming payment, even though there were objections from a practical perspective. That might change potentially, unless they change the legislation again, that's possible. But I think from that perspective, that ability, because it's really that pressure on the part of a taxpayer, because if you go to court, you must appreciate it's not confidential. This whole suspension application, and if you bring an application to court, it's not confidential. You bring an application to the High Court, and that is why all these things then come to the fore, because you must say, I plead poverty. And if you plead poverty, then your investment community will say, how can you actually plead poverty, and should I actually sell my shares, and all those type of things. So you must be quite careful what you say in these type of applications, because you actually want to send a different message to the investment community. And if you say, yes, there might be issues here, or my outlook isn't that great, and all those type of things, then your share price might be impacted as opposed to you succeeding with the SARS application. So it's quite an important issue, important aspect, but you must be quite careful, because it's not a confidential matter. For instance, if you go to the tax court and that type of thing, it's public, everybody can attend that, anybody can look at those papers, your submissions, and that's why a number of people don't want to go to court and rather settle and pay something. And if you pay something, it's about 40-50% of the capital nowadays as a general rule. So it's quite interesting. Underestimation of provisional tax. It's also quite an interesting thing. The reason why I mentioned that again, it was mentioned this afternoon again. But what happens in the context of listed and the bigger corporates, they have an ability to top up their provisional tax payments and estimates once they finalize their financial statements. And if that's the case, they don't have to pay the penalty in relation to the underestimation of provisional tax. But there's another penalty called the late payment of the provisional tax. Now, what has happened now, SARS said and the National Treasury said, if you don't pay your taxes, then you can't argue and qualify for this relief, in a sense that you've got this third provisional payment that you can make, and so bring yourself within that, we call it the 80%, 20% rule, because if you stole that and your estimates are within that 20%, then you don't have to pay that penalty as such. 1 million rand threshold, yes, it's increased and so on, but I think for the big corporates, it doesn't really make that much of a difference. So it's more for the individuals that this makes a difference. If you within 1.8 million rand, then you still don't have to pay the provisional tax. But the key issue really is there's still this practice to be able to top up. You call it whether or not SARS sent you that's paragraph 19.3 notice or not. You can still top up your provisional tax estimate to the extent that you finalize your financial statements, because a lot of things happen in the last month, and there's foreign exchange risks and gains and losses and all those type of things that happen at the end of the year. So you have that ability, and if you top up and you agree with SARS the amount concerned, then from that perspective, you don't, from a practical perspective, once again, you don't have to pay that underestimation penalty. Doesn't necessarily apply to everybody, but in practice, it applies to most of the big corporates. Voluntary disclosure, quite rigid. There's been some debate whether people should actually make use of the VDP process of late. The reason really being is that the unit is quite rigid. You come to them and you say, these are the facts and so on. They don't necessarily do an audit, so they accept the facts, but then you must pay the capital and interest. And importantly, prescription doesn't apply. So if something happened in 2005, then that's it, and then you must pay the interest from 2005 to now, even though it's simple interest. That's really and there's a standard agreement, you sign that, you pay your taxes, and that's it. The benefit is you don't have to pay under USP from that perspective, which if you go to SARS and auditors, it could be 10%, it could be 15%. But it's quite rigid in the sense of that you have to pay the interest. Metcash went to court, and they lost because of the agreement that they signed. It was now announced this afternoon that you can still make the submissions, and they're going to change the legislation. You can still change the submission in relation to the payment of interest. But SARS, as a matter of fact, does not allow you to remit any interest, because their test was the payment of the tax beyond your control. And they always say, unless there's an earthquake, maybe COVID, that's it. It's not beyond your control. So even though you may have the ability now to make submissions to remit the interest, it's very difficult to, and I think that one will actually get some success in relation to that, because of the fact that they say, is it beyond your control? And it's not. The payment's not beyond your control. And even if they take 5 years with an audit, and we've often argued that the delays in relation to the audit is also beyond your control, they don't accept that. So we'll have to see how this is going to evolve, because even though you may have the ability to make submissions, it's unlikely that, especially if you look at 89.2 interest, not the provisional tax interest, but the 89.2 interest, after the assessment, it's unlikely that they will ever accept that it's beyond your control just because you didn't think about that, you didn't know about something and so on, because they will say you were negligent. Why didn't you pick it up? For how many years and all those type of things. It's not beyond your control. You could have paid if you knew about it. And the taxpayer's argument is, I did know about it, but then they say you're negligent. So it's not beyond your control. So it's a very tough argument that you have in those circumstances. And of late, I haven't really seen any scenario where they actually remit the 89.2 interest as opposed to the 89 quad interest, which precedes the assessment. There they're more lenient, but the moment there's the assessment 89.2 interest, they are very reluctant to remit any interest. We'll see what's going to happen here, but I think from a practical perspective, it's going to be very difficult to get any success there. Just two more issues, very short. Non-resident employers, you always have this issue in relation to the deduction of PAYE. You have somebody here sitting in South Africa working. Do you need to deduct PAYE to the extent that you're a non-resident employer? They're going to at least link it to the fact that it must be, the employment must be linked to that permanent establishment. We also saw the OECD bringing out some guidelines towards the end of last year in relation to the swallows, or those people that follow the sun. So they work everywhere except for in the office. It's not me, Brent. It's not me. And the question is whether the place of work will establish this permanent establishment in the other country or not, those type of things. So it's, to a large extent, if they don't make decisions, they just work from home, they don't have an office or that type of thing. The OECD said there's more scope there. There's not a permanent establishment created. And if you look at the announcement this afternoon, it must be then linked to the PE, the permanent establishment in South Africa, in order for you to deduct the PAYE. Because if you look at the proposals last year, it was actually the opposite. Whether or not you had a permanent establishment, they actually said that you must deduct the PAYE. Whether or not you have any other presentation or any presence in South Africa, it didn't matter. They didn't implement that at least, and it seems that they backtrack a bit in relation to that, the deduction of the PAYE. So that's at least something that's good from that perspective. And the last one, the domestic treasury management company. Those of the bigger groups that do not have it, you're losing out, because it's quite beneficial. Number one, you're not subject to exchange control regulations. This domestic treasury management company can borrow foreign currency without having to go to the Reserve Bank, and I'm not sure who of you has been involved in exchange control applications of late. It's an absolute nightmare. I don't know what happened at the Reserve Bank, but it takes ages. Even simple applications are not approved. Takes 4 or 5 months. If you get something back, it's not what you've asked for. There's a huge problem to get exchange control approvals nowadays. So it's at least good that you don't have to do that if you've got the DTMC. And then secondly, the foreign currency are not subject to the 24I regime, that is unrealized gains that you have to pay taxes on that. You can do your preference shares now also under that, or borrow under that. You can make your investments under that, and they've also now indicated today that to the extent that you're a CFC and you make your investments out of that, they're also not going to force you to make the translation back to rand and then pay the tax. So it's quite beneficial. Yes, depending on whether you 1 billion rand, 3 billion rand a year, but it's very beneficial, and you must really seriously consider making use of that. Otherwise, it's a normal taxpayer, but the big benefit is that you don't pay those taxes on the unrealized gains or losses, number one, and number two, you don't have the problems in getting exchange control approval each time the moment you want to make that investment. Beneficial today, the whole issue that you don't have to translate into rand as well, which is also from a practical perspective. At least the rand strengthened over the last 3 months. You don't know what's going to happen in future, but it's a volatility, I think. That's a big thing about the rand compared to other currencies. And we don't want that, because you either have a gain or a loss, and you have to account for that, and you have to pay the taxes whether or not you actually have the cash, or alternatively, you have this loss which you can claim, but the next year you actually have the gain again because of the volatility. So it's also something to take into account, I think, to streamline that and the investments, especially into Africa, but it can be everywhere else. Generally, they only allow you one DTMC, so you have to choose either euros or dollars or whatever the case may be. But from a practical perspective, it's worth your while because of the fact that you can function outside the regime. as opposed to having to obtain a Reserve Bank approval each time from a practical perspective. So thank you so much. Thanks for coming. We really appreciate it. There's something to enjoy at the back there. If somebody, all the people that are not here already there. Thanks for the marketing team and all the guys sitting there at the back. We really appreciate that. And Annabelle and Gerard. Thank you, which is the most important, for being here and to listen to what we're rambling on. We really appreciate that, and enjoy the rest of the evening. Thank you.